Yields up, stocks down, live from New York City this morning. Good morning, good morning. Let's wrap up this trading week. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, pushing back on the pivot.
The Fed is not scared of financial markets at this point.
We've seen the markets already sort of pricing in this pivot or pause.
The pivot that really wasn't there and didn't really happen.
The Fed doesn't have to pivot to bail us out.
What that does is open the way to more aggressive rate hikes.
We've seen that massive 300 basis point pricing of the Fed.
We hear more coming out of Jackson Hole next week.
Powell understands, I think, but it's a tricky situation here.
The Fed's job is not done yet.
The rally's almost certainly overextended here.
We got one decent inflation report.
Even if they thought inflation was coming down, why quit now?
With 8.5% inflation, the playbook is very, very different.
There's still a lot of work for the Fed to do.
Counting you down to Jackson Hole, let's kick off this program with Flowbank's Esty Dweck and Eric Knudsen of Neuberger Berman. Esty, first to you. So much pushback against this rally. Are you leaning the other way?
Well, I think there are a few different aspects to the rally that give us a little bit of confidence that the June lows are going to hold. Now, it doesn't mean we go up in a straight line like we have so far. I think a correction will come and will actually be healthy, especially given what we've seen. But we've seen a lot of breadth to this rally, so that's the first step. The second is clearly you're talking about pushback. That means that sentiment hasn't changed. Investors remain cautious, pessimistic. If actually short positioning has increased since the start of the rally, and the rally started before the good news arrived. We didn't wait for the good CPI number, which only came out in August, to start this rally. It started when news was still disappointing. We had a couple of warnings from the chip companies, from the retailers, and the rallies, the good ones, I would say, start usually on some bad news. So those three aspects give me a little bit of confidence that it can continue. Though, again, I do think a correction will come at some point.
Marko Kolanovic had this to say: given our core view that there will be no global recession and that inflation will ease, the variable that matters the most is positioning, and positioning is still very low. Eric, is positioning what it's all about still?
I think positioning has been a big part of the rally that we've seen. And as a result, especially with relatively low liquidity in coming weeks, you could see this rally continue. From a fundamental standpoint, we're taking the other side. We're fading this rally. We think that there's more pressure to come on corporate earnings, on valuations, as central banks need to continue to maintain tighter financial conditions. That ultimately inflation is going to put some pressure on corporate margins, and slowing growth, whether we hit a recession or not, is going to have a negative impact on corporate earnings. So, while you can ride this for a little bit longer, we think there's more pressure to come on equities.
Eric, when are we going to see that weakness in corporate America? We thought we might see it this quarter. Hasn't transpired. I've seen the likes of Chris Harvey of Wells Fargo push that out into early 2023. What are you thinking about?
Yeah, so certainly we expected a little bit more pressure in the second quarter earnings, not so much in earnings, which we thought were still going to be reasonably strong, although they came in stronger than even we expected, but more revisions of forward earnings. And you have now started seeing those come down. Traditionally, if we were going into recession or even this degree of slowing growth, you'd see corporate earnings decline 15 to 30%. We're in a new world right now, we think. We think we need new playbooks for an environment where economic real growth could be negative and nominal growth could be positive 6, 7, 8%. That's an environment we haven't seen since the 70s. Nevertheless, we feel that, or we believe that some of this pressure has to translate into declining earnings from the growth standpoint, but also inflation starting to hit margins. So we are expecting another 5-10% markdown in corporate earnings, over the next 6 to 12 months. So that's going to start playing out. It might be second half of this year. It might be early in 23 as yield curves from the short to the medium term invert, and you start getting more concerned about recession in the second half.
Esty, speak to me about that weakness that Eric's speaking about. He's talking about it right now. You expecting that to transpire, materialize anytime soon? Or are you in the Chris Harvey camp and pushing that back out, pushing that out to 2023?
I think that earnings continuously surprise us on the upside. We know that there's going to be some pressure on margins. We were expecting it, as in we, the market, sooner. For sure, Q2 was better than anticipated. I think the market is prepared for something of a growth scare or some kind of slowdown. So if we get a little bit of a revision lower in some of these earnings expectations, it wouldn't be that big of a surprise. It's not all priced in when you do the math of your EPS for next year and the current valuations, but that expectation that we are going to see a little bit more of an impact is already there. And that's one of the reasons the sentiment is pretty low. But I do think we're going to have this disinflation trend continue, and I think that's going to be a bigger boost to sentiment than any impact on earnings from the third quarter, because markets are going to start to look at 2023 very quickly. And if inflation is coming down, then 2023 is going to start to look better.
Esty, so many people have doubted this rally off the June lows. Michael Harnett of Bank of America this morning coming out with some statistics, some numbers. I'll share those numbers with you in the audience. Average S&P 500 gain in 43 bear market rallies of more than 10%, going all the way back to 1929. The average 17.2%. The average duration 39 trading days. This one 17.4%, 41 days. He's saying textbook bear market rally. How much of that do you hear, Esty?
I think you can make statistics say almost anything you want. If you're in the more optimistic camp, you can point to how long it takes to make back a bear market and then to recover from that compared to the past, and how long the bear market lasted can impact how long it takes to recover. You can look at, again, the breadth of this rally, that it's been very, very rare occasion where sentiment and market action was as negative as it was in June of this year, pointing to the positive. Again, whether we take a breather, I think is guaranteed almost in the next month or so, or we get a disappointing headline on inflation somewhere. Maybe Powell's more hawkish than what the market would like to hear, since the market felt that the Fed minutes were maybe on the dovish side. Plenty of these things can happen, and I think some kind of correction later this month or into September makes sense, but I don't think that means that it's a bear market rally and we're going back below those June lows.
Futures are negative right now, down by 0.9%. Esty's not pushing back against the rally we've seen. Many other people are, including Barclays. Barclays this morning publishing this. Powell's speech at Jackson Hole may prompt a realignment in cross-asset dynamics. They went on to say, rising equities along with yields on the dollar month to date is confusing. Given less depressed technicals positioning, stocks may face a reality check. Do we get a reality check next week in Jackson Hole? Mike McKee, good to have you with us. It got confirmed, didn't it? We're getting that speech next Friday.
It did get confirmed. We are getting the speech. No surprise there. But the Fed continues to be surprised by some of the economic data that's come in, as I've been saying for some time. They know where they're going, but they don't know where they are, which is not a surprise because data are backward looking. Now, some of them in the last couple of days have said that's no big deal because we know where inflation is at the moment. It's a clear and present danger, as Jim Bullard told the Wall Street Journal yesterday. I don't really see why you want to drag out interest rate increases into next year. So put him down for 75 along with Waller and Kashkari. On the other side, and we were talking about this, the hawk turned dove, Esther George, her view, they know where they want to go, but maybe they won't be able to get there because the full weight of policy hasn't hit the economy yet. What will growth and unemployment and inflation look like in a year or so when the policy is having its full effect? So she's down for 50. Now, the interesting thing is that makes her a dove in the context of today's Fed. You look back and 50 basis points until this June was considered a very large move, and that would have made her a hawk. So where is she today? The Fed's usually moved in 25 basis point increments. So there is a third camp. Mary Daly on that side. They could do 50, they could do 75, but the important thing is to get it higher and leave it there for a while, which is a message we'll probably get out of Jackson Hole. So what do they do next? Well, this is where I get to play radio announcer and say, tune in again next week when our heroes meet in Jackson Hole.
Are you calling us? Who are the heroes here, them or us, Mike?
Them. I was thinking them, but it could be the surveillance anchors out there. And we also get, as you can see, some key economic data, particularly that PCE inflation number. So we'll see where inflation is going of the Fed's favorite measure, and we'll see what Jay Powell has to say about it all.
I'm just trying to keep it together now, Mike, after that promo. looking ahead to Jackson Hole, Wyoming. That's going to be our promo through the rest of next week now. Mike McKee, awesome. Looking forward to your coverage, sir, as always. Mike talked about Mary Daly there, the San Francisco Fed president. These were her words, and I think they're important words. I really think of the raise and hold strategy as one that has historically paid off for us. Now, think about how that stacks up with what the market is talking about. Market participants, they're talking about getting to a peak rate and then starting to cut almost straight away. And Mary Daly's talking about a raise and hold strategy. SD Dweck, that's where the division is right now in early 2023. We've got this strange conversation on Wall Street about going straight into rate cuts. The Fed's not talking about that. How do you think that difference gets resolved?
I think that first difference is already what the market is talking about as a pivot and what the Fed would look like. I completely agree. We're not anywhere near a pivot, and 50 basis points would be, which I think is probably more likely, unless we get a bad inflation surprise for August, the most likely, but that's still tightening. It's just the most aggressive part of the tightening cycle is probably behind us. Now, that second divergence is exactly what you're pointing to, is the view that by 2023, growth is going to be slowing. It matches some of those conversations you had with some of my colleagues about earnings coming down and a worry there. And therefore, it assumes basically the Fed will have over-tightened and will have to cut very quickly. It seems that the Fed is going to continue to hike, but maybe at a more normal and gradual pace into the end of this year, and then that allows them to wait and see. And I think the market is a little bit too optimistic, if that's the word we can use, about rate cuts coming early in 2023. I don't think that's going to happen.
Eric, these are trillion-dollar questions. The raise and hold strategy. Raise to what and hold for how long?
Yeah, I'm with Esty on this. I think that and by the way, I'm not going to call 50 or 75 for September. It's tough. That's a tough game to make those calls, especially when the market's so evenly balanced. What we do believe is that the Fed needs to get their terminal rate to between 3.25 and 3.75 and that they'll move there by the end of this year or very early next year. And then they do need to stay there for a while. And that's got to do with our view on inflation. Inflation is going to be sticky. Our expectation is core CPI is between 5 and 6 at the end of this year, and between 3 and 3.5 at the end of next year. In order to keep financial conditions tight, which is the Fed's goal here, they're going to have to get to a terminal rate that is higher than inflation and keep it there for some period of time.
What do you think that number is, Eric? Just to jump in, we've got Barkin speaking right now at the Richmond Fed, saying the Fed's committed to reducing inflation to 2%. How many times have we heard that? What does that actually mean? What are they willing to do to get it to there?
Yeah, I mean, that would indicate they need to get the terminal above the inflation rate, which would tell us that, in that range I cited, they need to be towards that high end of the range, 3.75, somewhere in the 3.5 and even as high as 4% range for that terminal rate, and they can't just be there for a day. They've got to leave it there for a little while until core, PCE gets into that 3-ish range. I don't think, I know they keep anchoring on the 2%. Larry Summers has said they should probably, move away from the 2%. Frankly, I think if they get a 2 handle on the number, they can declare victory. But that's going to take some time, and that's going to need, the terminal rate needs to stay up a little bit longer certainly longer than what's priced into the market, and that's where we're putting our money.
They've got some work to do. They keep telling us the same thing. Eric, Esty, you're going to be sticking with us. We're down on the S&P 500 by 0.8%. Stocks are down, yields are higher. You can see it on a 10-year right now, up 8 basis points to 297. On a 2-year, up 6 basis points to about 326. 326 on a 2-year yield this morning. And the dollar a whole lot stronger. I'll touch on that a little bit later. Let's get you some movers going into the opening bell. Here's Abby.
Hey, John. Well, yes, we are looking at the worst day potentially in 3 weeks. Taking a look at some of the outsized movers. Not surprisingly, Bed Bath & Beyond is one of them, again, to the downside, down about 20%. This on the news that Ryan Cohn's RC Venture is out at a $68.1 million profit. That's a 56% gain. Suggests that they were buying on the way down. If you look at where the stock was 5 to 7 months ago, lots of meme pain for some of those other traders. Ross Stores off of its lows, down less than 1% at this point. They cut their earnings guidance for the year by about 10%. Swollen inventories, but there are some analysts, including Wells Fargo, that likes this new view, so maybe that's why the stock's off of its lows. To the upside, Deere is up about 0.9%. They did narrow their net net income forecast, small ag and turf, plus construction and forestry weak, but not weak enough to send the stock down. And then finally, GM up about 0.8%. They've reinstated their dividend and buyback. They will be reinstating a 9 cents per share dividend starting in September, and they have raised their buyback amount to $5 billion from $3.3 billion. Not so shabby. The first time they've done that in 2 years.
Since the pandemic. Tom and I were talking about that a little bit earlier. Abby, thank you. Coming up, the Fed doubling down on taming inflation, even if it means recession.
As we continue to raise rates, as we continue to raise costs, so to speak, of borrowing across the economy, that makes it more likely that we would end up in a recession.
That conversation up next.
I don't think we're in a recession right now, but as we continue to raise rates, as we continue to raise costs, so to speak, of borrowing across the economy, it should be tapping the brakes on the U.S. economy, and that makes it more likely that we would end up in a recession.
I thought Mike McKee's Jackson Hole promo was so much better, and we should just clip that and play that throughout next week. Let's get you to some retail stories. Surging prices pinching U.S. consumers. Ross Stores, the latest retailer to cut its outlook, citing slower spending and higher inventory levels. The team coverage starts from right now with Abigail Doolittle and Taylor Riggs. Hey, Abby.
Hey, John. Well, yes, another retailer bites the dust. Ross Stores reported a not-so-great quarter, but it was more about the outlook. They cut their earnings outlook for the year by about 10%. They also missed comp sales by about a fair amount. They were down 7%. The operating margin down 3%. So a very familiar story. But the biggest point, probably inventories, up more than 55%. And we've seen this store many times. Walmart, Home Depot, Target, Lowe's, all having inventories that are up on a year-over-year basis by 12 to 38%. So Ross Stores inventories up about 58% on a year-over-year basis really stands out. Some analysts saying it has everything to do with those consumers with smaller wallets. They're just not shopping as much, so that inventory, that product is staying on the shelves.
Taylor, have we worked our way through this inventory pain?
Target would argue that they have, but we're not hearing that from some of the other companies. We were speaking with Poonam Goyal as well, saying that she's not confident that any other sort of retailer is on that right track. And John, this sort of brings up this broader conversation about some of the inflationary, and we know that when you start cutting all of that inventory, the disinflationary, if not flat-out deflationary forces that brings, and all the wage pressures as well that's underway, the real wages that are negative, all of this really highlights just sort of the inflationary pressures that we just continue to talk about on this program. You fold that back, of course, back into the price action, maybe some mixed reaction. We're talking a lot about Kohl's to the downside. Some of the other ones, and you could argue BJ wholesalers, Target, Walmart, Lowe's, even Costco, as you mentioned, just sort of the lower expectations heading into this, and so you're getting some decent price reaction since then, but I think we have a long ways to go to get through the second half of this year.
Taylor, awesome as always. Taylor Riggs there alongside Abby. Latest out of Wayfair, job cuts, 5% of the global workforce. And the latest from PwC, so many people have talked to me about this survey, and if you haven't seen it, I'll share it with you. About 700 US executives and board members across a range of industries surveyed by PwC. This is the outcome of the survey. Half of respondents said they're reducing headcount or plan to. 52% have implemented hiring freezes. More than 4 in 10 are rescinding job offers, and a similar amount are reducing or eliminating those sign-on bonuses we all heard about in the last couple of years. Back with us for a final thought, Esty Dweck, Eric Knudsen. Esty, can we escape this year without seeing some labour market pain in the United States?
The labor market has surprised us over the last few months. We've been expecting this weakness, and it hasn't materialized. I think at some point we will start to see a slowdown there and something of an impact, but I don't think it's going to be as painful as some of these surveys are painting. I think it's still relatively small numbers, and I think it's going to be gradual, waiting to see a bit how this goes, and if some of these wage pressures ease as well, kind of in tandem with some of the pressure on margins, because we've had this big move in commodities downwards as well. Some pain, or at least a slowdown for sure. Huge pain, I'm not convinced at this point for this year.
Eric, if you look at the jobs numbers 2 Fridays ago, nothing to see here, everything's great. You look at that survey, it sounds absolutely terrible. Where's the truth lie?
as I was somewhere in between. And other corporate leader surveys and small business surveys, share similar views. The outlook from the executive suite or for small business people is pretty challenged. That said, the Fed has highlighted, and we've been commenting on this gap between job openings and job seekers is as high as 11 to 12 million openings for 6 to 7 million seekers. First thing that has to happen is those open positions have to get closed. And I think that's what we're seeing is the retrenchment in an aggregate basis is coming in the open positions as opposed to the hiring. And there's the potential for labor hoarding as companies who have struggled to get workers on board are going to be hesitant to lay those workers off, and that's starting to play through some of the productivity numbers. And so I think that what you're going to see is if we do see a recession, and we're still 50-50 on that in the next 12 months, it's going to be shallow. It's going to be consumer retrenchment led. It's going to be inventory adjustments, kind of like traditional recessions from the post-war period, rather than the last types of recessions we've seen, which have had major balance sheet issues, deleveraging issues, over-investment issues. Corporate fundamentals, corporate balance sheets, consumer balance sheets remain healthy. So we see, more gradual, shallow pain as opposed to something much more systemic.
Eric, awesome to catch up, as always, alongside the brilliant SD Twag. To the two of you, thank you. Futures recovering just a little bit. We're down about 7/10 on the S&P. Coming up the morning calls and later, Richard Bernstein's Dan Suzuki, staying away from tech. That conversation still ahead around the opening bell. This is Bloomberg. Minutes away from the opening bell, equities down. Here are your morning calls. First up, Wells Fargo downgrading Hewlett Packard to underweight, seeing weaker PC demand and possible macroeconomic impacts on its printer business. Next up, KeyBank raising its Apple price target to 185, pointing to strengthening trends and new data showing a rapid recovery from softer results. And finally, Morgan Stanley cuts its Meta price target to 225, expecting a decline in user engagement rates to weigh on the company's revenue growth. That stock at 171. Coming up, growth stocks outperforming value by the most in 22 years last month. Richard Bernstein's Dan Suzuki expecting a reversal, buying cheaper defensive names and selling big tech. That conversation up next. "24 seconds away from the opening bell this morning. Good morning. Here is the price action. Slightly negative. We're off the lows. We're down about 7/10 on the S&P 500. On the Nasdaq 100, down about 0.9%. After the close on Thursday, we were looking to squeeze out a fifth straight week of gains with the S&P up by about 0.1%. We're going to take out that week of gains this morning at the opening bell. That is the opening bell. Switch up the board and get to the bond market. Yields look a little something like this on a 10-year higher, much higher, up 8 basis points, approaching 3%, 296.66. Dollar stronger, eating up G10 this morning. The US dollar, euro weaker, euro dollar negative 1/3% at 10057. And crude bouncing back. We reclaim once again a $90 handle, a 90 handle on WTI. We've done that a few times over the last couple of days. $90 and 71 cents on WTI. At the opening bell, let's get you some moves. We can do that with Katie Greifeld. Hey, Katie.
Hey, John. Well, let's kick off with General Motors. It's getting a little bit of a lift this morning after reinstating dividends and buybacks after a 2-year pause. The automaker will now pay out a 9-cent quarterly dividend. It was 38 cents all the way back in April 2020, but still good news. Deere, though, not so much. The machinery maker cut its full-year outlook this morning, thanks, of course, to the supply chain. Earnings also took a hit from higher expenses and production inefficiency. You can see shares down by more than 2%. Moving down the board to some of the more speculative corners of the equity market, you have MicroStrategy falling about 6%, on track with Bitcoin's 8% drop or so. MicroStrategy still your best proxy for crypto moves in the equity market, even though Michael Saylor no longer CEO. And finally, Bed Bath & Beyond. I know Taylor's going to dig into this one in a little bit, but just know Ryan Cohen completely exited his stake after just 5 months. Those shares down just a stunning 40% or so.
I like how diplomatic you are about that, the slightly more speculative parts of the market. Katie, thank you, as always. About a minute and 30 seconds into this, we are negative by 0.6%. The one single industry group on my screen right now in the green is healthcare, up by a little more than 0.1%. Lagging right now, communication names down about 1%, discretionary down about 0.8%. As you might expect, information technology down 0.8%, given where bonds are trading right now, with yields higher, much higher. I'm told today that $2 trillion worth of options expire. The person telling me that, Abigail Dillittle. Hey, Abby.
Well, John, it is a big day, and at this point, $2.1 trillion. It's getting even more larger in the possibility for some volatility as this expiration happens. And many thinking that with the expiration, with all these options expiring, that it could also be the expiration of the 2-month rally we've seen. Now, when we break it down a little bit, the S&P 500 futures, that's the biggest piece of it. Single stock, another big sleeve, and then ETFs, the E-minis. So in any case, lots of options as we're talking about expiring. In fact, Kevin Kelly over at Kelly ETFs, he is saying that we could see volatility pick up in the next few days as this does expire, as this expiration happens. What we're looking at now is the put-call ratio, and you can see that it's been going down. That tells you, this is the open interest, that tells you that the volume on puts has been declining, which is kind of a head-scratcher given what we've had this year. But over the last 2 months, as we've had this rally happen, you can see puts going back up. So folks are hedging. And this, as the VIX has gone below that key 20 mark for a little bit, now back above it. 1 point to make there, John, and you can see it, that year-to-date uptrend has been broken. So it's unclear whether or not we're going to stay in complacency zone or up. But one thing I can say from hosting Options Insight every day, one key measure for volatility, a lot of folks are saying that it has less to do with options in some ways than the VIX, but it's the Fed that is driving all the volatility. So all that Fed liquidity suppressed volatility. Now that that's coming off, we're starting to see real volatility.
If in doubt, blame the Fed. That is the theme of this show, as you know. Abby, thank you, as always. One stock to watch, Deere, down about 3.8%. Both Deere and Ross Stores, both missing estimates this morning. Deere cutting its profit forecast. Ross lowering its EPS outlook. The retailer CEO saying the following: we're facing a very difficult and uncertain macroeconomic environment that we expect will continue to strain our customers' discretionary spending. Taylor back with us for more. Hey, Taylor.
Could we blame the Fed for that, too?
Of course we can. Just blame the Fed,
there
Taylor. Carry on.
Well, here's the good news. Deere isn't doing that. But like you mentioned, sort of on the bottom line and that full year bottom line, trimming the forecast. You're not seeing an outright cut, but you're seeing more of a narrowing. So previous estimates for full year had been from 7 to 7.4 billion, now looking at 7 to 7.2. And again, sort of costs and rising inflation, still a big story for this company. And so analysts, of course, and investors looking at that stock, you're off just less than about 3.5%. A little bit of a similar story, I guess you could argue, is Ross Stores. I think some of the more interesting notes out from the street, BMO Capital Markets saying more questions than answers in this report, and a Citi analyst saying that it's going to be still a big drag when you think about some of the headwinds to the consumer. And in terms of some of the other off-priced retailers, he still prefers TJX and those companies. And that's actually where you can see some of the differences in all of the different retailers that we're looking at. Ross and Walmart, when you think about maybe the lower expectations, trying to get some of the inventory behind it. Target will look at maybe the last couple days, given that they reported a few days ago. But you are really seeing a mix here of people who are looking at maybe more of that grocery business when you think about Walmart, Target versus Ross, which doesn't have that omni-channel presence. A lot to digest.
Are we going to talk about Bed Bath & Beyond a little bit later?
Stay tuned. 5 minutes. I'm so ready.
5 minutes away. Taylor Riggs, thank you. You know that saying, not blame the Fed, but don't fight the Fed. Don't fight the Fed. This is Bank of America. Very few fear the Fed. Think pivot and the return of meme stocks. Yet last time the Fed ended a hiking cycle with negative real rates was 1954. And even assuming CPI gains half over the next 6 months, whether the Fed knows or not, they're nowhere near done. Katie Lyons has more. Hi, Katie.
Well, John, does the market know that, even if the Fed does maybe know that or not? That is what Bank of America is pointing out here. And the inflows we have seen into equities, nearly $8 billion over the last week. But what I find so interesting is into what kind of equities we are seeing the flows, because after massive underperformance of growth relative to value in most of this year, that has changed over the course of the last 2 months. Since July, over July and August thus far, about $9.2 billion has flowed into U.S. growth funds. More than $3 billion has come out of value. And off the low since mid-June, it's been the more expensive stocks leading the way, especially those large cap growth names. Mike Larned also pointing out that just 4 stocks, Apple, Microsoft, Amazon, and Tesla, have contributed 30% of the rally we have seen off the bottom in June for the S&P 500, which speaks to the narrowness of the rally, but also to investors just not being scared of high multiples again, because growth stocks trade at nearly 24 times forward earnings, more expensive than the broader market, and of course significantly more expensive than those value stocks. As for why investing in growth hasn't been as scary of a proposition over the last 2 months, a lot of that has to do with bond yields, because higher borrowing costs usually are more threatening to those richly valued stocks due to the implications for the discount rate and future cash flows. So the reversal of those rates has led to somewhat of a re-rotation within the equity market. But with rates climbing higher this morning and the Fed still hawkish in the lead up to Jackson Hole, John, I wonder how long that growth rotation can stick.
Rates up, stocks down. That's the theme this morning. Kaylee, awesome as always. About 7 minutes into the session, we're lower by 0.6 on the S&P. The underperformance from big tech and the Nasdaq down about 1 full percentage point. Earlier on this morning, Kaylee, Tom and I caught up with Federated Steve Cheverone. He said investors should sell big tech. Take a listen.
The rally we've seen in some of these tech stocks, they're just too high. They're still trading at 25 times, and we think they've got to trade somewhere closer to 19. So we would be inclined to sell tech here, and for the time being buy defensive dividend paying stocks outside those couple of big names that are high quality tech. But in general, what's run is the junk, and I would fade that in favor of higher quality equities and higher quality bonds.
Dan Suzuki of Richard Bernstein echoing that call, writing the following: buy cheaper defensive fixed income duration and sell expensive cyclical equity duration like tech. Dan, I'm pleased to say, joins us right now. Dan, awesome to catch up, buddy, as always. I wanted to start with a quote of yours. This year's sell-off has been the market's way of trying to hit investors over the head with the idea that they should avoid clinging to yesterday's winners. But few seem to be listening. Dan, why do you think that is?
Well, yeah, first of all, I mean, the reason that I was saying that is because, you know, there's not much debate about the fact that we've been in a bear market this year. There is some debate about whether that bear market is over, but putting that aside, you know, we've been in a bear market. And the one thing that you can hang your hat on in markets is that bear markets, they always signal a change in leadership. So that's telling you that you can't cling to yesterday's winners. You need to look beyond, you know, what's been working over the last 10 years, and that's not what you're seeing in the markets. People continue to go back to their tried and true investments that have worked, and that's normal, right? You saw that in the wake of 2008. You saw that in the wake of 2002, and so this is very, very normal. People have a very hard time thinking that things will change, but things are changing. People just don't know it yet.
Dan, do you think we face the prospect of a lost decade chasing old winners?
I think that's right, and it's not necessarily that they're going to persistently be bad, you know, every year, you know, over the next 10 years, you know. But the starting point was so high, you know, for these assets that it just makes it incredibly difficult for these stocks to put up really, really strong returns. So I think from that perspective, you know, you are likely to see very, very muted returns, if not a lost decade, because for one, the valuations are so high. Embedded in that is expectations are so high. But when you come down to the reality versus those expectations, you're seeing what the reality now is, that those growth rates cannot be sustained. Those margins cannot be sustained. There's going to be more pressures, like regulatory pressures, like tax pressures, like we saw this week. All these things are going to compile relative to those very, very high expectations. And I think they'll make it very difficult over the next decade.
So, Dan, where do you think the leadership comes from?
Yeah, John, you know, the easy answer is that I don't know, right? I mean, that's what we've spent a lot of time focusing on, is, you know, where the fundamentals are improving. So regardless of my opinion on what the next decade is going to look like, you know, we're really focused on what is, in terms of what the data is telling us. Now, if I were to guess, you know, if the last 10 years has really been about disinflation and U.S. large cap growth, you know, my starting point is that it's probably going to be somewhat the opposite. So that means pro-inflation assets, not necessarily over the next 10 months, but over the next 10 years, pro-inflation assets, and also a little bit more international, a little bit more small caps, and a little bit more value. But again, a lot of those aspects are very cyclical, and in this slowing cycle, it's probably not necessarily the best time to be going full bore into those assets.
Dan, what I hear from you is that we're not just going back to the old winners, we're not going back to the old playbook, we're not going back to the old regime of the twos, 2% inflation, 2% growth. Do you remember that? Are we not returning to that, Dan, even after next year?
I don't think so. I think, from a secular basis, I think we're in a new paradigm. And that new paradigm is going to come with higher inflation, higher interest rates, and less globalization. Now, clearly, the more dominant force is going to be this slowdown in potential, profits recession and all-out economic recession that we see in the coming years. That's going to overwhelm the secular story in the near term. But over that longer period of time, I do think you're going to see higher highs and higher lows in terms of both inflation and interest rates going forward. And that's going to be very different. And that's a result of a number of different things, including, the sea change in globalization, the sea change in, power shifting from corporations back more toward, employees and workers, and, various sorts of commodity dynamics as well.
I remember a phrase that you shared with me in the depths of the pandemic, and it read as follows: better to be late than early. Don't chase the rally. Dan, why is that true? Why does that hold true still today?
Well, first of all, empirically, John, it's true, right? You're referencing a piece that I just put out earlier this week that just looks very objectively, at all the bear markets over the last, 90 years or so. And basically, more times than not, it's better to be late than early. In this case, we looked at 6 months late versus 6 months early. But what's more important than that, about the argument around the timing is what that being late allows you to do, what being patient allows you to do. And it allows you to focus in on the incoming data. With more time, you get more data and you get confirmation, because the only way that you're really going to get sustainable rallies is that you get some combination of a bottoming in profits or bottoming in liquidity. You need to see some signs that those things are starting to get less bad, if not better. And time that being patient allows you to do that. The unfortunate thing for markets today is that you're not seeing any of those signs. Profits continue to decline, and my guess is that we're going to be a profits recession, by early next year. And then liquidity is going to continue to tighten. That's kind of what you were focusing on earlier. The Fed's going to continue to have to tighten. I agree with Michael Hartnett. That's spot on.
Dan, awesome to catch up. Dan Suzuki there of Richard Bernstein on the later.
Thanks, Sean.
On the latest, don't chase the rally, seems to be the message from Dan. That phrase in his latest research, and something I remember he told me a few years back as well. Better to be late than early. Equities right now down 0.8% on the S&P 500. On the Nasdaq, we're down about 1.35%. Talked a lot about what's been developing in the bond market. Yields in the UK, in Germany, across Europe, in Italy as well, higher, much higher. That bleeds over stateside too. The 10-year up 8 basis points to close to 3% at 2.97. Your 2-year up 7 basis points to about 3.27. Coming up, the meme stock craze continues. Bed Bath & Beyond plunging once more.
What we're seeing is a lot of option plays that we saw in Bed Bath & Beyond and GameStop, AMC. But again, everything's being delta hedged. So if you're hedging if you're a market maker and you sold an option, you're offsetting that trade in the equity market.
That stock down, and down hard. We're off by 41%. The latest coming up.
What we're seeing is a lot of option plays that we saw in Bed Bath & Beyond and GameStop, AMC. But again, everything's being delta hedged. So if you're hedging if you're a market maker and you sold an option, you're offsetting that trade in the equity market. That activity is actually, the option activity is translating into the short and long part of the market due to the delta hedging of the stocks.
Bed Bath & Beyond plunging yet again after its second largest shareholder cashed out his stake. The stock recording its biggest intraday decline on record, dragging other so-called meme stocks down in sympathy. That name is down 42%. Taylor Riggs has more.
For perspective, coming up into this, pretty much every day in the last month, John, it was 10, 20, 30, 40% gains every single day. But again, a lot of news in the last 2 days, which means you see a 20% drop yesterday and a more than 40% drop today that you just mentioned. So given a big run up, you're still looking out in 2 days alone, more than 60% drop. The why behind this, you may not have fundamentals to the upside. We certainly have some fundamentals to the downside. RC Ventures, we know that was backed by Ryan Cohen, sold sold, and he was one of a larger investors, sold that stake to zero. Got a good profit, $68 million. But again, some questions about the timing. And again, what does it mean for a strategy, for a real big turnaround story that was supposed to be Bed Bath & Beyond? Finally, of course, I mentioned sort of the long-term picture here and the decline that today represents, as you can see, wiping out a lot of these gains just on today and the last 2 days alone. I could do meme stocks longer. I think we'll leave it there, but I just think sort of these big questions, as always, are just the timing and really what it means for some of the other traders who got involved and really had high hopes.
Taylor, awesome coverage this morning, and looking forward to the coverage a little bit later at the close, of course. Taylor Riggs with Caroline Hyde a little bit later on. We're looking at the more speculative parts of the market, where the volatility typically lies, crypto. Looking at Bitcoin down by a little more than 8%. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Well, in crypto, an 8% move isn't realistically all that hard to come by, and yet it definitely is a decisive move downward for Bitcoin today. We are back below that $22,000 level. One thing I have noticed after watching this space for many months now, John, is that Bitcoin is really, really good at getting stuck in ranges. First, a couple months ago, we were in the 30,000 range. Now we've been hovering in the low 20s, made some gains since mid-July, but really now giving all of that back due to the fact that this market seems once again to be focused on a higher Fed, more hawkish Fed, and really just risk sentiment overall is getting depleted, which is why you are seeing crypto taking it on the chin today. And as Bitcoin prices go, pretty much all crypto-related equities go with it. The likes of Riot Blockchain, Marathon Digital, MicroStrategy, which is really a Bitcoin proxy, given how much of the cryptocurrency it holds on its balance sheet, Coinbase, the exchange, all down in the range of 9 to 11%. And just to give you an idea of the kind of activity taking place beneath the surface, according to CoinGlass, about $220 million of crypto positions got liquidated in the span of just an hour earlier today, and Bitcoin equated to roughly half of that. One note I would say here, John, is that really you can expect Bitcoin to basically go the direction of the NASDAQ 100. When risk sentiment is sour and it weighs on equities, by and large, it's going to weigh on Bitcoin as well. Really, since the pandemic era began, that correlation between Bitcoin and the NASDAQ 100 has been very, very strong, John.
Kelly, thank you. And Kelly, thank you for everything this week as well. Double time with Tom Keene and I. And I said thank you for tolerating us a little bit earlier, and I meant it. So you get the promo too. Bloomberg Crypto, Tuesday, 1 p.m. Eastern with Kelly Lyons and Matt Miller. Do not miss that. Looking forward to that next week. Bit of news for you. I want to show you this coming from Dow Jones. Preparations are underway for Chinese leader Xi Jinping to travel to Central Asia to meet with, here you go, Russia's Vladimir Putin and other leaders at a regional summit in mid-September. That, according to people familiar with the planning. That from Dow Jones just moments ago. Want to get you in touch with the price action more broadly. The S&P down 1%, the Nasdaq down by 1.5. Abby has the sector price action. Hey, Abby.
Hey, John. Well, you know, it seems that hitting resistance this week, the S&P 500 still below that 200-day moving average is really sticking, because right now we're looking at the worst loss. The S&P 500, as you're mentioning, down 1% since July 26th. And you can see it's the heavyweight sector down more than 1%. Industrials, materials, tech, financials, discretionary, and communication services. So lots of those mega cap. On the upside, healthcare. That, of course, is a defensive sector, so that's not such a positive. In fact, that's what we're seeing on the week. At this point on the week, there are only 3 sectors higher. 2 of them are true defense, staples, and utilities. And then you have energy creeping higher. The worst sector, that's all about communication services. Meta, Google, Comcast, Verizon are down. Interestingly, though, John, what's helping out that staple sector be on top this week? Costco and Walmart. So we've had these big retail earnings, but some of them, those discount retailers, big box retailers, beating lowered expectations, leading on the week.
Abby, thank you. If you wanted a quiet end to the trading week, you are not getting it. The S&P 500 down 1 full percentage point. Up next, we'll bring you the trading diary from New York City. This is Bloomberg. We are ending a 4-week winning streak on the S&P 500 if this sticks. We're down about 1% on the S&P, down more than 1.5% on the NASDAQ. That's the price action. Here are the things you need to be looking for through the next week. Here's your trading diary. Minneapolis Fed President Neil Kashkari speaking on Tuesday, plus retail earnings keep rolling in. Macy reporting results a little bit later on in the week. We get US GDP and another round of initial jobless claims on Thursday, plus the Fed's annual Jackson Hole Forum kicking off on Thursday. And finally, a host of consumer data, Mitch, personal income and spending to round out the week on Friday. And we hear from Chairman Powell. on Friday at 10 a.m. Eastern Time. From New York, this was the Countdown to the Open.